Oh, good morning, guys. Happy Saturday. Man, I'm having a morning. Let me tell you, it's like everything. I don't remember what it's called, but it's one of those things to where everything that can go wrong will. Right before, first of all, I apologize for being a few minutes late, but right before I started streaming, it's like everything happened at once. I My camera wasn't working. I had a bloody nose. Didn't have my water, so I had to run out and get that. So anyway, uh, we're here. We're making it happen. Happy Saturday. What else can I tell you guys? Welcome to the Dividend Happy Hour, episode 116. Um, that's gonna bug me, but I know. Old camera, Murphy's Law. There you go. That's what it's called. I knew it started with an M, but yeah, guys, we're gonna make it happen. The show must go on, and I'm so stoked to be here with you guys. I'm sorry we missed last night. Um, but I wanted to put out that video on Clear Secure yesterday, and I knew the live stream would get in the way of that. So I hope you guys don't mind me rescheduling it to today. And if you haven't checked out that video yet on Clear Secure, definitely check it out after watching this stream. But I'm so stoked to be here with you guys on this fine Saturday morning or Saturday afternoon, depending on where you're at. Normally I'd have a cup of coffee right now, but I've already had like 3 cups of coffee today. So I need to hit the pause button on that and sip a little water. But with that, guys, let's kick this thing off the best way we know how. I know it's not our usual happy hour time, but hey, let's still kick it off here with a cheer. So grab whatever it is you're sipping on here. And here's to you guys. Thank you for tuning in with me today. And, thank you guys all for showing up at a different time than usual. I appreciate you guys tuning in, and maybe because we are doing it at a different time, we'll have some newer faces in here, some people that don't usually get to catch the live stream live. So nonetheless, cheers. Here's to you guys, and here's to those dividends. Here's to, I'm looking up here like it's a camera. Goodness gracious. Here's to the pursuit of that sweet, sweet cash flow. Cheers. Let me know a few things here, guys, in the live chat or in the comments below if you're watching the replay. Number one, I want to know which stocks did you buy this week? What did you add to your portfolio? I want to know that here in the chat. Number two, what are you sipping on? I mean, it's Saturday morning, Saturday afternoon. Maybe we got some coffee, some tea out there. Maybe we got a little Irish coffee, depending if you're, feeling froggy today. But let me know what you're sipping on, if anything. I see Shamir's got his usual Coke Zero. That's good any time of day. Number three, did anything cool happen in your guys' portfolio this week? Did you hit any new income milestones? Are you at an all-time high in your portfolio? I know for some of us, it was kind of a good week in the portfolio. Right now, I think actually mine is sitting close to an all-time high. So yeah, let me know if anything cool happened in your guys' portfolio or outside of the portfolio as well. Any cool life stuff that you feel like sharing? Anything that happened, you guys would love to hear about it. But what else? Number four, do we have any first timers here in the Dividend Happy Hour? Let me know here in the chat if this is your first time tuning into the Dividend Happy Hour, excuse me. And in case it is, typically we do this live stream every Friday night, starting at 5 p.m. Pacific time, 8 p.m. Eastern time. This week is a rare exception where we switch it around, but usually we'll do this live stream once a week. And I always post about it for some of you guys. I know this is a random time. Maybe some of you guys missed the announcement yesterday coming into the stream. But I always post about the live stream on the community page of my channel. So yeah, if you ever want to know about the schedule there, I usually post it up Friday mornings. And like I said, it's usually Friday nights at 5 p.m. Pacific time, 8 p.m. Eastern time. So that's where we're at. Let me go through the chat here and see who we got in the building. Looks like there's 100 of us here this morning, which is really cool. 96 right now. So let me go all the way to the top here. I see Adon. I see Shamir, of course. We got Tony, who likes this time slot. Cool. That's good feedback. Lucas is here. JJ's here. Kyle catching the live this time. Nice. The Shadow's here. Caleb, what's going on? Yeah, there we go. So that's kind of the cool thing, I guess, about doing it at a little different time, is we get some people who normally can't catch the live stream. So Craig, happy to see you, and I'm glad you could make it. Stonked up, what is going on? Maton's here, finally able to catch the live. Yeah, cool. Let me take a pause, hit the pause button real quick. I want to see if I can switch. Oops, if I can swap this camera real quick. Let me see if it'll work for me. Last time, no, I don't think it's going to. Shoot. Whatever. Okay, let me turn that off. I'll deal with it after. What's gonna happen, and this happened last time, as soon as I get off the stream, I'm gonna check it again because this is gonna bug me, and it'll work. Classic. Anyway, where was I? Oliver's here. Good morning, my friend. Sven, what's happening? Arunus? Arunus? Did I get that right? Anyway, good to see you. Alex is here. What's up, Alex? Nuno is here. First time in the live. Well, happy to have you. Dividend Diary, all the way from Poland. What's going on? Oh, this is, stonked up. This isn't bad news. Your investment portfolio got cut by 70% because you bought a place. Man, I think that's good news. Congratulations on the new place. That's a huge step. So good job. And you'll build the portfolio back up in no time. So yeah, not bad news at all. That's great. So Luis is here. J and J. What's up, Luis? I feel like I haven't seen you for a while, man. So hope you're doing well. J and J, first time all the way from Spain. That's really cool. Thanks for tuning in. John from Jacksonville is here. Jacksonville, John, having some tea. Nils is here from Germany. Abubakar is also here from Germany. What is going on? Let's see. This is crazy. Okay, Luis, almost 100K in SCHD this week. Portfolio hit 220K. Nice job, man. Good stuff. InvestRight is here. What's happening? R is here. Mr. Ortiz is here. Jimmy. There you go. Sipping some chocolate milk. Nice. That sounds good. Chris is here. Tony is here. What else we got? Jerry. What's up, Jerry? Who else we got here? Let's keep going. Maybe that's Grace is here. What's up, Grace? First time in the stream. Welcome. Hope you enjoy it. And we'll run it for an hour or so. So it's 11 my time. We'll end it sometime soon after 11 o'clock. We'll go for a full hour for sure. So usually it lasts an hour. Typically, I like to ramble, so it ends up going over an hour, but not too much longer usually. Chirash is here. What is going on? An is here. What's happening? Or Ann? Let's see. Wow, Dividend Diary is close to 300K in the portfolio. Very nice. Big Bad Jim Betts in the building. Hey, Jim. Kyle, this is my first time live, second time watching. What's going on, Kyle? I hope you enjoy the live. You'll have to let us know if it's different watching the live versus watching the replay. Catching it live, it's just, there's certain magic to it. Joey's here. What's happening, Joey? Did I already say what's up to Caleb? If not, Caleb, what is going on? Yeah, Sam Adams Winter Lager. That sounds good. It's 1 o'clock over there, so good stuff. Richard's here from England. Nice. Very, very nice. Turbo. What's going on, Turbo from Indiana? Dresh is here. Are you tempted by the recent Zoetis drop? Yeah. I'd be lying if I said I wasn't, but I got to stay focused. I'm building up Clear Secure. I actually dumped if you watch the video from yesterday, then you'll already know this, but I picked up a lot of shares of Clear Secure this week. And actually, if we jump over here, let me show you my position and where it's at. If we jump over here to the dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description. So this is where the portfolio is sitting at right now, 84.3K. Yesterday was a pretty solid day, up about $550. And so this week I ended up buying 13 shares of Clear Secure. And this is where the position's at right now. I have 57 shares, and my initial goal is to get it to at least 100. So we're officially over halfway there. And my average cost is now $32.18. Prior to buying those 13 shares, it was like 33 and some change, maybe even close to like $33.50 per share. So we were able to bring that down by quite a bit, but this is where the returns are sitting at. So I'm down 13.7%. Totally fine with it. Not a big deal whatsoever. I'm still accumulating, obviously. So I actually think this is the best possible scenario playing out, being able to average down and buy shares at a cheaper price, for a 13.7% discount in relation to the rest of my shares. So, definitely not going to complain about that. But Dresh, long story short, yeah, I'm focused on building up that Clear Secure, and we'll see what happens after that. So, Trevon, what's going on, man? Picked up, a couple of French companies here, LVMUY, which is LVMH, and LRLCY, which is L'Oreal. Nice moves, man. Janice is here. What is going on? Mm, yeah, hope this time change will not be a one-time thing. Yeah, it I don't know. It's kind of fun to do these morning streams, but I wouldn't want to do like a Friday night stream and then turn around and do a Saturday stream. Um, so I don't know, but I don't know. Maybe we can work a morning stream in some other times. So we used to do the Monday morning walk to 100, and that was fun. That was a good way to kick off the week, but I don't know, maybe at some point we'll bring back like Market Mondays, and just do a weekly Monday stream, and I can show you guys the buys for the week and just make it a point to do that on Monday on the stream, live action. So Fast Eddie, what's going on? Tim, what's happening? So there we go. Picked up a small position in you, and also Evolution. Nice. Yeah, we talked about that one um in last week's stream, and that one's looking really good. Peter's here. Health and Wealth is here. First time live. Cool. Well, I hope you enjoy it. Bob's here. Hey, Bob. Hope you're doing well. Let's see. MeTube is here. High Tech, what's going on? I'm almost caught up here in the chat. Monsieur Legoman, what's going on? Let's see. Who else we got here? Supreme from Nepal. Supreme from Nepal. Owen's here. What's up, Owen? What do I think of General Mills? We'll take a look at General Mills momentarily. I'll save that comment. Let's see. Why buying? I don't really know what this question is. I'm happy to answer it if I can get some clarification. Yeah, let me know exactly which company you're talking about. Maybe Clear Secure. Maybe you're talking about something else. I don't know. Michael's here. What's up, Michael? And this is a good question here too about Pepsi versus Coca-Cola. So we'll save that. H32 asking about Robert Half. This is a quick answer. Just, what is your view on Robert Half since you started talking about it? So I mentioned it in, sorry guys, hold on. If you know, I made a video last month talking about Robert Half. And in fact, I wrote a newsletter on it as well. It was like my, top dividend stock to buy for October. And since then, what's it done in the last month? Let's jump over to the screen real quick. So RHI, and let's see. I think it's had a pretty good month. And it's funny, my dad actually reading my newsletter, he picked up some shares of Robert Half. So his position's off to a great start. So it's up 13% in the last month. I would say my views on it haven't changed. I still think it's a great company. If we look at the financials, revenues going up, earnings per share for the most part's trending up. 2023 was kind of rough, but overall this trend is up. Free cash flow per share is looking great. And the company has no debt either. So, I think it's a really solid one, and it's been a really good dividend growth stock. Honestly, these are pretty typical dividend growth stats right here. 2.5% yield, nice double-digit 5 and 10-year dividend growth CAGR. 11.5% in both departments. So really solid there. So yeah, my view on Robert Half hasn't changed. I mean, it's obviously just a little bit more expensive now, but I still think it's a good company. So the gift that keeps on giving. What's going on? I said, hey, what's going on? Monsieur, I like saying that. Monsieur. My friends and I, some of my best friends and I, we'll call each other that just for fun. And instead of saying like man or dude, it's like Monsieur. Just one of the weird things we do. So, okay. So we're all caught up in the chat. I want to go through the two questions that we have starred here. And there's this one about Visa and Amex. So let me just say right now, this is also a very quick one, and I feel like I've talked about this one so much. So the key difference between Visa and American Express, just fundamentally, is this: Visa is strictly a payment network. They're not an issuer of cards, and therefore they're not responsible for the debt that the people who use their cards take on, because that's what credit cards are. That's what credit is. It's a line of unsecured credit, and when you use that, that's obviously debt that you have to pay back. So Visa, as a strict payment network, is not responsible for that debt. If their customers didn't pay their credit card bill, it's no sweat off Visa's back. They strictly make their money as a toll booth, as a payment network. And so And there's other things that they do too, other value-added services, as they call it, which could be things like help with marketing or, cybersecurity, stuff like that, um, that they help their their customers with. But as far as the payment network, they just collect revenue from the transaction. They make a small percentage of on the fees for every transaction. Um, Whereas American Express does that as well. They're a payment network, but they're also an issuer of cards, meaning they are, which in essence kind of makes them like a bank. They are on the hook for the debt that their customers take on when they use the credit. And there's pros and cons to that. That adds an element of risk, but at the same time, that's another stream of revenue for them. American Express can generate, interest revenue from the unpaid credit card bills. You know what I'm saying? And as you guys know, that's the interest rate on that is extremely high. So it's a good source of revenue. So that's the key difference between Amex and Visa. Now, in terms of payment network, the size, Visa, bar none, is a much, much larger payment network. It is the largest payment network in the world. It facilitates the most transactions out of all of them compared to MasterCard, Amex, Discover, and all the other ones out there. So that gives Visa a certain advantage, and it's more widely accepted than American Express. You can use Visa in a lot more places than you can Amex. So those are just some of the fundamental differences. But if you look at the financials on both of them, I think it's pretty solid. So I think really, if you're considering either of those companies, like I said, the financials look great for both of them. So I don't think that's a concern in either department. But I think if you're considering both companies, you need to think about which one you'd rather own. Do you like just having the strict payment network, or do you like the fact that American Express also generates revenue from interest, from the interest income? So interest on the outstanding debt from unpaid credit card bills. So I think you should think about that when it comes to those two companies. Um, I thought that was going to be a quick response, but I guess not. So let me see. Um, Yeah, Lucas wants me to look at Estee Lauder. Yeah, we'll take a look at that one. Capital One, actually, real quick, while we're on the subject, is very similar to Amex. They're also an issuer of cards. But to me, it's like, if I'm thinking about all these different companies, I'm going either Visa or MasterCard or Amex there. For me, in my mind, I don't really see the draw to investing in Capital One compared to Amex, um, and also compared to Visa or MasterCard. I'd rather invest in um, one of the others there. So, yeah, Marcellus says most portfolios could fit both. Or I think you're talking about maybe Visa and Amex, and I would agree with that because they operate in similar industries, but they are slightly different. So, and they're both good companies. So I think you could make the argument that you could own both if you wanted to. Um, okay, there's a question about Realty Income there regarding Exxon or Chevron. I don't really have a serious opinion about that. I think they're both fine. So, but let's go through some of these questions real quick, guys. I want to go through. I have 4 of them starred right here. Then I want to jump over to Snapstock and go through it with you guys because we just released functionality for real estate investment trust today. Like right before we went live, I was going through this stuff with a fine-tooth comb, and I have some notes that I want to share with you guys. I want to show you what it looks like and share with you my feedback. And I'd also really appreciate your guys' feedback as well. It would be super helpful. And just real quick, in case you've never seen Snapstock or you're not familiar with it, it's this right here. We were just looking at it. And this is a stock analysis platform that I just came out with about a month ago, actually. It's officially been live for a month. And, like everything, this is a constant work in progress. It's been a lot of fun. And we just rolled out functionality for REITs. So I want to go through this with you guys and get your feedback, share mine as well. I think it'd really help me think through some of these notes, and it would also really help in the development of this and stuff like that. So anyway, we're going to spend some time doing that if you don't mind. But starting here with Owen, what do you think about General Mills? So let's see. First thing that I want to do, obviously I'm very familiar with the company. They do cereal, stuff like that, but I want to see what all their brands are. So we're going to go over here. I want to go to the website real quick. It's going to open that tab. I'll go back here. I want to see the brands for General Mills just real quick. So our brands, is it just cereal or is it more? Okay, so it is a bit more. So we've got pet food here as well. Okay, that's good. So Annie's, Autumn Gold. Okay. Betty Crocker. So strong brands, like right off the bat. I forgot about Bugles. I love Bugles. Couldn't tell you the last time I had one, but really love them. So good. Yeah, a lot of good cereals. Dunkaroos. Oh, I forgot about these too. So good. Fiber One bars are really good. Gardettos, guys. Oh, this is probably hands down one of my favorite snacks. Gardettos, Cheez-Its, Goldfish. I love tortilla chips, like Doritos, or even just straight up plain tortilla chips. Yeah, so I'm getting hungry. Okay, let's look at the rest of the brands though. Kix. I used to eat Kix a lot when I was a kid. So there's some really strong brands in here, not limited to just cereal as well. So Pillsbury, that's great. Oh, Reese's Puffs, my goodness. So yeah, okay, so definitely some staples, pretty well diversified across different types of snacks. You got cereals, you've got dinner stuff like Annie's, and even breakfast stuff like Bisquick. You can use that for pancakes and waffles and whatnot. Blue Buffalo, you got your pet food there. Other snacks. So I dig it. I like these brands. I think it's a pretty strong lineup and it's pretty well diversified. Looking at some of these metrics here, this is interesting. The free cash flow yield is very high at 7.4%. Okay, so they're up 4% in the last year. Looks like they were up recently. They were up a lot higher than they are now. They've seen a pullback in the last couple of months. So okay, wow. The dividend stats are okay. 3.5% yield, low payout ratios, dividend growth rates, okay, yeah, kind of moderate. Looks like it's, seeing some consistent growth in revenue, very nice growth in earnings per share. And I would say the free cash flow per share is, steadily trending up as well. So I think all of this looks good. And this is, at least in terms of revenue, this slow and steady growth is what I would expect from a consumer staples company such as this. But I will say this earnings growth looks pretty impressive. I wasn't expecting to see it so high. Decent margins, mid 30% range, and that's been consistent. The net income margin has definitely gone up over the last decade. Free cash flow margin looks like it's been consistent as well. Debt to free cash flow is not bad, about 5. It's not terrible. Yeah, and they've been a decent dividend growth stock, Not super aggressive growth, but consistent. So overall, I'd say General Mills looks like a pretty decent consumer staples company. And if you're looking for something with stability and consistency, it doesn't look to be at a terrible valuation. If you're looking for something maybe a bit more on the defensive side, this seems like it's not a bad one to consider. So I like it. Okay, so Michael wants to know which one is better, Pepsi or Coca-Cola? So let's first look at the key difference between the two is that Coca-Cola is strictly beverages, whereas Pepsi is beverages, plus they also have a lineup of snacks. They own all the Lay's brands, so we're talking like Lay's, Ruffles, Doritos, and some other stuff as well. I think they have rolled gold pretzels, I think is in there. Could be wrong on that. But so anyway, Pepsi's a little bit more diversified in terms of the portfolio of products that they sell. And as far as, here, let's do this. As far as the financials go, I think Pepsi is a little bit faster growing too. I think. The dividend stats are pretty comparable. I think Coca-Cola has a higher starting yield, but has a slightly lower dividend growth rate. So that is something to consider. Pepsi's, we can see that looking at the revenue and earnings per share, this is growing. We can definitely see that trend upward there. So that looks pretty good. Free cash flow per share, interestingly, looks like it's been going down over the last 10 years. So according to this, So I would say that's something to keep in mind. We'll take a look at Coca-Cola here soon too. Yeah, the free cash flow margin as well has been declining. And with this, I would imagine, guys, we will see the free cash flow payout ratio going up when we get to the dividend section. Um, debt's not terrible at all. 4.4 for the net debt to free cash flow. Steady dividend growth stock here. Um, I think they're a dividend king as well. I think they have 50 years of dividend growth. And let's go over here, look at the payout ratios. So yeah, this is concerning. This is the concerning thing about Pepsi is that the payout ratios are pretty dang high. Even the earnings payout ratio, getting up into the mid 70s, which doesn't look like it's uncharacteristic for this company. The 5-year average payout ratio, I think I said PE ratio a moment ago. My bad. The 5-year average payout ratio is 74%. So that's on the higher side. This is concerning. This is pretty concerning. If it persists, and I think if it stays as high as it is, I think it's gonna be problematic for the dividend. So this is something that I would definitely keep an eye on with Pepsi. Now, if we look at Coca-Cola, we'll take a quick scan in the financials there, super quick because I wanna move on here. Um, so yeah, actually, I guess the dividend yield is pretty comparable to Pepsi's. It's actually a little bit lower with a similar 5-year growth rate. So I was mistaken there. Um, what's going on here? Do we have a dip in free cash flow per share here in the trailing 12 months? But otherwise, I guess it's been interesting, right? Like revenue went down the last half of the 20 teens here, but then it's since rebounded and has gone back up. So overall, and it looks like overall the revenue over the last 10 years on average has stayed pretty flat and has slightly declined according to this. So that's something. The earnings looks pretty good though. Earnings has been going up. Free cash flow per share for the most part has been going up. So I think that looks fine. Similar margins. Actually, Coca-Cola has higher gross margins than Pepsi. It looks like their free cash flow margin has been heading in a better direction as well. A couple dips here in these last couple of years, but otherwise it's gone up. Lower net debt to free cash flow. So that's, the advantage there goes to Coca-Cola. And I think we'll see lower payout ratios. Well, maybe not. Maybe it's been pretty similar actually. I want to compare this to Seeking Alpha real quick though. Is that right or is this off? So it's not too far off. 60, 68. So yeah, that's really not too far off. Pretty in line. Similarly high free cash flow payout ratios, and there's been some years where it's dipped, gone up over 100. So let me look at this though. Does it show the free cash flow per share here in the trailing 12 months? So yeah, it's definitely dipped here. We can see it's gone down from 225 to 80 cents in the last 12 months. So yeah, I would say with both of them, that's something to keep an eye on. But I don't know. When I used to own Coca-Cola, I sold out of it to put into Vici Properties, I believe, which I think was a good move. But I don't know. Obviously, Coca-Cola is a stock that's near and dear to many dividend investors' hearts for obvious reasons, and both of them are dividend kings, so there is that. But these days I look at both of these companies, and they don't really excite me. There's really nothing about them that jumps out to me. And makes me want to own either of them. I kind of feel the same way about General Mills. Really, kind of these days, I used to really like consumer staples, but used to be like my favorite sector. But I think these days, really the only one that only ones. Well, I guess really the only one that I own, two of them that I own are Altria and Procter and Gamble. I personally like the idea of owning Procter and Gamble more than something like Coca-Cola or Pepsi. I just like that type of product better. I just like that type of product better. I think it'll be I think it's harder to disrupt, I would say. Not that, soda needs disruption, but man, there's so many different beverage brands, and I feel like they're popping up every day. But these two, I believe will, and I guess Pepsi does snacks too, so there is that. But yeah, I just like the idea of investing in toothpaste more than I do soda these days. I don't know if you guys feel the same or differently, but before we move on to the next comment, guys, there's two more I have starred. I want to I want to go through the chat and see what I missed. I see a question real quick about Nike. Go check out my most recent, not my most recent, but the recent video that I did, 3 discounted stocks to buy in November. I talk about Nike quite a bit in that one, and I've talked about it quite a bit this year. I think it's a great company. It's, looking like it's a pretty decent time to buy. So, this is a great question about earnings calls. Good morning, guys. I see some of you guys just now jumping in here. Jonah, what's up, man? Yeah, and thank you, Daryl. Thanks for the reminder. Guys, if you haven't done so already, there's 170 of us here in the stream. If you guys have the capacity to do so, I would appreciate it if you hit the thumbs up button one time. Just let me know that you're enjoying the stream. That'd be fantastic. So, let's see. Let's keep going. Okay, so caught up here in the chat. Let's see. Okay, so let's go over to Lucas wants to know about Estee Lauder. And we'll check this one out because I like the industry. I like the beauty industry. I think and I talked about this recently with L'Oreal, which was my top dividend stock to buy going into this month in November. But I really like the industry. I think it's a pretty resilient industry. I think beauty products, whether it's, well, in the case of L'Oreal, it's like, not only makeup, but shampoo and professional beauty products. I think all of the things like that are pretty resilient. And, no matter what's going on, I think people will still want to look good. People will still want to take care of themselves. And, skincare as well. That's certainly part of it. And that's been a growing industry. So I think it's a pretty important industry, a pretty sticky one. But let's take a look at Estee Lauder because I don't think it's as strong as something like L'Oreal. Okay, so this one's, and I understand wanting to be interested in this one because it's taken a big hit, but I think it's justified if we look at the financials. So, if we just scroll down here, let's go look at some of these growths. I mean, the revenue growth has been pretty nice, I will say, but the earnings growth, the earnings per share over the last decade has been, pretty unexciting. And it looks like it's actually trending down over time. Free cash flow per share has stayed relatively flat. It looks like there were a couple good years here, but for the most part, it's stayed pretty flat. The margins, this is where I kind of have started to lose interest with Estee Lauder is the margins here. Gross margin has been going down over the last 10 years. It's still great. Like it's still, mid 70% on average, which is great gross margins. I think this is pretty comparable to what we'd see with L'Oreal. The net income margin, though, here has really, really gone down. And I think actually there have been periods where it's been negative. If we cross-reference this with Seeking Alpha, I think there have been times where it's been negative. Maybe I'm mistaken on that, or it's been close to being negative. Yeah, I guess it looks pretty similar to Snapstock here. I always like to cross-reference them and look at both of them just to make sure that they're in line with one another. But I would say that for an investment, I wouldn't want to invest in something whose margins look like this, and also whose on an absolute basis whose earnings are so spotty like this. I think the revenue looks good, but these two don't really jump out to me, and this is a bit concerning to me as well. So with that said, I think there are probably better investments out there. With that, this company's taken on a lot of debt here, and this isn't quite right, I believe. So let me look over here too. I thought let's actually crunch the number here. So in the trailing 12 months, net debt, 7.6 billion as of their last report. Okay. So 7.6 billion. Free cash flow in the trailing 12 months is 1.9, so 2. So I guess it's actually not too bad. So forgive me, guys. I was mistaken. Debt situation doesn't look too bad. Dividend growth has actually been good too. So yeah, they took a little dip in 2020, but I don't think that's a huge deal. Otherwise, it's been a pretty solid dividend grower. But I would say that some of these growth metrics and some of the profitability metrics here are a bit concerning to me. So that's something that keeps me from Estee Lauder, and makes me want to, like, if you're going to own something here, I would say L'Oreal looks like the better company. But the drawback to L'Oreal is that it's, at least for us US investors, is that it's a French company. And so there are additional risks that come with that. You also have to buy it as an ADR, which is a little bit different than buying like a share of a US company. So, that might be a turnoff for some as well. But I think just looking at this, I think this looks a lot better. The free cash flow per share has grown better over the last 10 years. Earnings per share has been better as well, with the exception of 2018 here. Earnings per share has been trending up and to the right. So like I said, similar gross margins now as Estee Lauder. Estee Lauder used to have higher gross margins than L'Oreal, but now they're actually pretty comparable. The net income margins have been actually going up over these last handful of years, so that's good. And then free cash flow margin, yeah, for the most part was since 2020, it's kind of come down there. So there is that. And then the net debt to free cash flow looks to be a bit more favorable than Estee Lauder, but still, based on what we saw with Seeking Alpha, Estee Lauder's net debt to free cash flow didn't look bad. So, and I didn't look at the payout ratio. We should do that. We'll go back to Estee Lauder and take a look at that real quick. For L'Oreal though, it's really not too terrible. I guess it's 60% ish for the earnings, and then maybe a little bit lower for the free cash flow. What was Estee Lauder's? So bit higher for the earnings. Well, for some years, I guess it's really spotty. These were really good. 26, 35 really jumped up in 2023. Trailing 12 months, that's concerning too. The free cash flow payout ratio historically has been pretty good though. So yeah, maybe it's not as bad as I initially thought. So real quick, Mystic Fire with a $2 super chat. Thank you so much. Big fan. What's your opinion on Sony? I don't know that I've ever looked at Sony. We can take a look at it just real quick. Let's jump over here. What's the ticker for Sony? Just the company name, I suppose. Okay, so looking at this. Don't know what's going on with all this here. So the revenue, my initial impression, revenue and earnings look really good. Solid sales growth, solid earnings growth for sure. Is that real? $802 per share for the earnings? No. So that's off. We're off here. Something's off here. Something is off here. And this one doesn't even pay a dividend. So like this wouldn't even be in my wheelhouse anyway. We'll take a look at it though. I will say this one doesn't really jump out to me either. The earnings have been very flat over the last decade. Pretty much no earnings growth, it looks like. It says it pays a dividend though. So maybe they just recently cut their dividend. Yeah, that looks to be unless Seeking Alpha is tripping, but so if Seeking Alpha is mistaken, if this company still pays a dividend, this actually looks like a pretty good dividend growth history. Margins have been pretty steady. The operating margin's gone up over the last 10 years. That's good. Let's look at the free cash flow. So this doesn't look too bad either. I don't know. Same thing, I guess, as like General Mills or Coca-Cola or Pepsi. This one just doesn't really jump out to me. There's nothing really that excites me about these financials. So yeah, I'm gonna leave it there. This one, it's just kind of to me. So Kyle wants to know, any idea if something specific happened to Realty Income on a fundamental level, or is this drop just post-election reaction? Optimistic on economy means rate cuts come in slower. Yeah, it could be that. I would imagine that Realty Income's performance, which I actually have not kept. Well, yeah, actually, I guess I have. I've seen it go from the mid 60s to now mid 50s. But yeah, I would say it's more just macro stuff like that than anything company specific. From my understanding, they actually just had a pretty decent quarter. If we go look at some of these results, I haven't gone through the earnings call yet. That's on my to-do list, but um, let's check this out. Same store rental revenue growth stays put. Um, I actually don't want this. I want the, occupancy is still high. This is what I want right here. So miss on FFO. So that could be something, but it doesn't look like it's a crazy miss. Big jump in revenue. So yeah, I would say it's probably more macro related, just kind of eyeballing it here. Um, but either way, I don't think it's whatever drop just happened. I don't think it's anything to be concerned about. So, okay, this is a good question from Joey, and I actually think this is the first time I've ever gotten a question like this. Joey says, curious, when you tune into earnings calls, what are you looking for? Green flags versus red flags. So, when I listen to earnings calls, I like to obviously tune in for the financial highlights, just hear what management has to say about those. And the green flags and the red flags there are obviously pretty obvious. If there's like a miss in earnings or a drop in earnings or free cash flow or something like that, I like to get the commentary behind that and see why things went the way they did. Um, but I wouldn't say that I look for any specific green flags or red flags. I think those are pretty. You can get a lot of those just from reading the high level numbers or reading the press release as well. Um, so I think that'll tell you a lot. But really, the listening to the earnings call is just to get the commentary on why the results turned out the way that they did. Um, and so when I listen to the earnings call, that's pretty much what I'm listening for. Just a little bit more in-depth conversation on, what happened. And then you get to the Q&A section past the prepared remarks, and you get to hear a little bit more context too, depending on what the analysts ask. And I think that's good too, because you get to hear the management team more unfiltered, and you get to hear just more honest commentary aside from just things that are already written down for them. So I would say more than anything, that's what I'm listening for in the earnings call, not specific green flags or red flags, because going into listening to them, you can already get a sense of what the financial red flags were. So hopefully that makes sense. Oh, so okay. This is a good question from Johnny. After this question, guys, we're going to jump over to Snapstock, and I want to go through my notes with you guys. Just catching up here in the chat. So, Johnny, do you ever feel like you're limiting yourself to by only investing in dividend stocks, especially when you're missing out on amazing returns from companies like SoFi and Palantir? No, I don't ever feel like I'm missing out on returns from not investing in companies like Palantir and SoFi. For me, it's important to have a dividend. I'm a dividend investor by nature. It's important to me to have this cash-based relationship with the companies I own, where they pay me a percentage of the profits. I like that it holds them a little bit more accountable to their shareholders. I think the dividend does that. And I think I also like that the returns are less dependent on share price fluctuations, which can happen on a whim. And for companies like the ones you just mentioned, like that can definitely happen. Those can be very, very volatile. And it's like, sure, they've seen some crazy runs recently, but they've been all over the place. And I just don't really like being at the complete mercy of what the share price is doing. Because really the share prices in a lot of ways are driven more by emotion and human behavior and psychology than they are, especially in the short term, in momentum and hype. It's more a lot of it is more that than it is tied to the actual operational performance of the business. And the dividend, you can't fake the dividend. Okay. Like if a company doesn't have isn't generating growing earnings and growing free cash flow, then it's not going to be able to afford its dividend and continue growing its dividend. And with that said, it kind of forces you to only invest in fundamentally strong companies. And I think those are the kind that you should be investing anyway. And that's nothing against SoFi or Palantir. I've really not looked into them, but the gist of it is it's important for me to have a dividend, especially with my long-term goal being to not sell the shares in my portfolio. The only way I'm going to benefit from something like a Palantir or a SoFi is if I have to someday sell those shares. And, you know, it leaves a lot up to chance. You have to time that. And really, like, I don't really want to do that with the stocks in my portfolio. I like to buy these companies and hold on to these businesses. And I think that's really what business ownership is. It's not to flip them. It's to take part in a percentage of their growth and their earnings from the cash flow they spit off. And that's important to me. And like I said, I don't ever feel like I'm missing out on things like Nvidia and I know Nvidia pays a dividend. I don't ever feel like I'm missing out on things like SoFi or Palantir because I know that someday if I were to own those, I'd have to let them go, and that would be something I just don't want to do that. So I feel like that could be and with that said, like there are so many. I feel like there's this mistaken idea that just because you invest in dividend paying stocks that you're not gonna see growth, and that's just not true. There are plenty of great dividend paying companies out there, great dividend growth stocks that generate really solid returns. Williams Sonoma, up until recently, I was generating pretty solid returns with Clear Secure. I think over time I will as well. Snap-on, I I much prefer to invest in those companies, those type of companies. They give me the best of both worlds. I'm able to benefit from some share price appreciation, total returns, and including the dividends. And the dividends, I get to have my cake and eat it too, I guess is what I'm trying to say. So, um, let's see. But yeah, that's a really good question. And like I said, it's one that I get a lot, but yeah, I don't like investing in non-dividend paying companies. And I really don't like that there's that idea that people think because you're investing in dividend paying stocks, you have to sacrifice returns or you're going to automatically underperform because you're buying a stock that pays a dividend. It's just not true. And there's so many examples out there that prove that it's not true. So hopefully over time that goes away. Okay, so guys, we're all caught up here in the chat. Finally, this is a good question from James. So, and I'm actually going to save a couple of these. Let me go to that one comment we just answered to. I want to save that because I think that'd be good to revisit in a future video. So, let me see. And Johnny, thanks again for the question. It's a good one. Really good one. And I think too, it's dangerous, like basically the root of what you're getting to in that question is FOMO. Do I have the fear of missing out? And I think that's one of the worst things that you can have as a dividend investor, not a dividend investor, as an investor in general. I think that having that fear of missing out and, if not fighting against that is going to lead you to make really poor decisions in the short term. And it's something that you'll constantly have to fight against. And really the fear of missing out is what drives bubbles. People see their neighbor or someone they know getting returns from stock XYZ, and they want to get that too. So they start to buy that stock. And then the next person sees that as well and decides to buy into that stock. And then you have all these people, buying into this company, whether it's Nvidia or GameStop or AMC, and maybe Nvidia is different than GameStop and AMC, but there's some symmetry there in the sense that a lot of they've really been driven by hype in a big way. And there's so many other companies. There's always at least one company that's the hot stock. And a lot of times it's driven by momentum. And maybe at first it's not. Like maybe at first it's driven by fundamentals, but it starts to get away from that. The more people that pile in, the more people that want to take part in the recent gains, the more of those that pile into that stock, the higher it's going to push the share price up. And it just gets to a point where that becomes unsustainable. And it gets to a point where it reaches this I'll say point one more time. It reaches this critical point where it just can't go on any longer. And from that point, there's only one direction it can go. and that's down, and it brings it back to reality. And that's just not, I just don't want to take part in that. So sorry, I didn't mean to keep going on that tangent. But James, to get to your question now, my friend, did I get a super chat? I don't. No, I didn't. I didn't miss the super chat, Charles. I saw it. So wow. Let's see. So James, sorry, I'm distracted. I'm all over the place. So, what are your 2025 investment and dividend goals? So, I would say that my main goal, I don't know that I have any dividend income goals at this time. My main goal, though, is to get the portfolio to $100,000. And I think we can get there. We're about 16K away. And I think by just, keeping on as I've been keeping on, I think we'll get there. But obviously, that's pending market performance. So we'll have to see what 2025 looks like from that standpoint. But at this point, that's really my only real goal for now. But maybe as we get more into the year, I'll have some more pop up. So we'll see. What about you guys, though? I want to put it back on you guys. What are some of your goals for next year? Okay. Yep, keep on keeping on. So guys, finally, I want to get over to Snapstock now. And so in case you missed it earlier, like I was saying, we just released functionality for real estate investment trusts. So now you can look up, like Realty Income or, Vici Properties, the rest of the gang, and it'll show some REIT specific metrics. And I'll show you what that looks like over here, just real quick. So let's do that. Okay. So we're over here. This hasn't been updated yet, but we can see we've got things like the price to book or the P to A FFO, price to adjusted funds from operations, the AFFO yield. We've got some other REIT specific metrics here as well, like the FFO per share, AFFO per share, some like AFFO margin, SG&A margin, just some stuff that maybe is a bit more relevant to REITs than it is like a normal company like a Visa or Coca-Cola or something along those lines. Similarly with the dividend stats, we've got like the FFO payout ratio, AFFO payout ratio, stuff like that. So, man, what is going on? Okay, so here's the thing though. It's good, like we're off to a good start, but it's not perfect. It's got some bugs. And so I want to go through some of my notes with you guys, just share with you some of my feedback on what I think needs to be improved here and how we can make it better. And as we're going through this, I'd love to get your guys' thoughts as well. Let me take a sip of water real quick though. Okay. So, where can we start? So first things first, we need to adjust these up here, the valuation and the dividend section. These still say things like PE ratio, price to free cash flow, earnings yield, free cash flow yield. So obviously these are relevant to normal companies, not really REITs. And the same thing is true here with the dividend. So these need to be replaced with, the AFFO payout ratio, the AFFO yield, P to A FFO, sorry, price to adjusted funds from operation, AFFO yield, AFFO payout ratio, stuff like that. So that's one definite thing we need to do. Easy thing. And all of these changes I think should be pretty easy. So that's one thing. Also, one thing I noticed too, this is on other companies as well. These metrics are missing the percentage sign. So that needs to be fixed. What else we got here? It looks like this down here, if we go down to like the debt, it's in a percentage. So 857% for the 5-year average debt, but it needs to read a number. So this needs to be reformatted to like 8.57 and 7.91. So that's something, like I said, a lot of small stuff. One thing that we just added to this too, and you guys might have noticed it, is these sliders right here. So if we go to like this, you just, slides over, you see the charts. It didn't used to be that way. It used to be like, for example, with the dividends, there's 6 different charts here. And instead of having the slider, it used to be, just two columns basically in this section. So these three here, then you'd have another column right below it in the section. And the reason that we switched to this right here, the sliders, was because for it to look good and for it to make sense, for the just have the columns, you have to have basically three charts. If we had, for growth here, we've got 5 different charts. These 3 and then these 2 right here. And if you had 5, if we just had 2 columns with the 5, it would look wonky because you'd have like a missing chart here, or we'd have to resize the second column with the 2 charts, and it just didn't, it didn't look as good. And so that's where we came up with the sliders here. But after using it, I'm not sure if I like it. I like having everything laid out right here on the page. I like just being able to scroll down a little bit and see the other charts. And so that obviously poses a problem for the growth metrics here where there's 5 charts. So I think we'll end up narrowing this down to just 3 charts. I think we'll keep revenue. I think we'll keep AFFO per share. And I think we'll keep book value per share as well. I think we could probably do without NOI per share and FFO per share for now. And if I think of another like relevant growth metric for REITs, we can add that to bring it to 6, but 5 is just not going to work. There's 6 different charts for dividends and buyback. So this column will work here as well. And if you guys have any ideas for that sixth chart, that 6th metric here under the growth section, let me know. I'm all ears. So that's another thing. That's a big one. What else? We just updated the header as well. So now you can see it's sticky right here. If you scroll down, the company name follows along with it. I think it would be cool to reformat the header here. So it's all together. You've got the Snapstock logo, you've got the search bar, you've got the company name, and we'll need to add the ticker symbol here as well. And I think it would be good to have all of these, I think it'd be good to have all of these just right next to each other. That way, when you scroll down, instead of it just being the company name, you've got everything. You've got the logo, you've got the search bar here for easy access, and you've got the company name and the ticker symbol. This is a step in the right direction, though. I'll tell you guys what, maybe it's just me, but I found myself having to constantly scroll back up to the top to remember which company I was looking at. So, but I would say those are my main notes. The only other things, I need to go through these metrics with a fine tooth comb. There's actually one more thing I'll share too, but I need to go through these metrics with a fine tooth comb just to make sure everything's accurate. They look pretty good with Realty Income, and I cross-reference them with Seeking Alpha just to make sure we're, kind of in line with one another. But I was looking at like KRC, for example, or even Vici Properties, and I noticed some more discrepancies here compared to what I was seeing with Realty Income, like especially in the AFFO per share. This pretty much shows it like going down over the years, and that's not really the case. Their AFFO per share is actually going up. So I need to go through these just to confirm that all of the calculations are correct. We're using the right metrics. So that's another thing. And then the last thing that I noticed, so we have these info blurbs right here. Used to be if you just hover over it, it'll pull up a blurb kind of like this that explains what the metric is, why it matters, and the calculation behind it. Used to be able to just hover over it and it will show it. Now you have to click on it. There's this little animation and then it shows it. I really like how it turns the entire chart into the blurb, but I think it would be easier to use if it just displays upon hover with no animation if it was immediate. That's how it used to be. So I'd like to get back to that. And I would say that those are my only initial notes. And I probably will come up with more as I spend more time with it. But those are the initial things that I've noticed. Also, the last thing too, the 5-year CAGRs and the 10-year CAGRs. It used to be formatted a little bit differently. I like how it used to be formatted. This right here, these used to be centered up here in the chart, and I think that was a cleaner look as well. So pretty much, for the most part, pretty minor stuff. But yeah, those are my initial notes here. Still, it's usable for sure, but it's, we still got a little bit of work to do, but it's cool to take steps with it. Cool to take steps in the right direction with it. So, but I'd like to get your guys' thoughts too. I know most of you guys haven't used this yet. But upon looking at it, a lot of you guys have seen this at least a handful of times in the videos. So I'd love to get your guys' feedbacks, what you'd like to see from something like this, what your favorite qualities are in a stock analysis tool, and just be really helpful to get some fresh eyes on it and some fresh opinions. So, um, yeah, I'm all ears, and I'd love your guys' feedback. But right here, yeah, so this is exactly, could the title of the graphs have some way you hover over it? Exactly. So yeah, like I was saying, now it's you have to hover over it and click it, but it would be a lot easier if you just hover over it and then it makes the transition. So, Flack Factory, yes. So this is a paid product. You get it by becoming a member. You get access to it by becoming a member of the investment club, and there's a link to that in the description of the video as well. If you want to check that out, you can get some more information. Um, yes, H32. I like this. This is a cool function to compare two or more companies. That is on our to-do list for sure. And let me tell you guys too, just what we have coming up. So we're going to get this REIT thing situated. Once we get everything finalized with the REITs, once that's all good to go, the next step is going to be to add a toggle to where you can see the quarterly data. So right now it's just annual. We want to make sure that we want to add quarterly data so you can toggle that. And that's next. After that, we're going to do financial statements. So you can see the full financial statements in here as well. And then after that, there was one other thing that I don't quite remember. Maybe it was one other thing I don't quite remember. Maybe it was ETFs. I don't remember what it was, but we have some other ideas for qualities or functions that will roll out too. And that's one of them, and the ability to compare two different companies. So, yeah, ETFs for sure. I agree. That'll be pretty easy. So for ETFs, you really won't need a lot of these charts here. You won't need revenue and, you know, profitability stats and stuff like that. Dividends, pretty much just dividend stats from what I can tell. Dividend stats, expense ratio, which doesn't really change over time. I think that would be pretty much it for ETFs. So that should be pretty easy addition. But yeah, if you guys have any other suggestions, any other ideas, let me know. But Ron says, well, before I get to Ron, John says, do you drip any of your holdings? Yeah, I only drip the Roth ones, kind of like you're saying here. Here, I'll switch gears here. I only drip the Roth ones, just SCHD and VU, but all the other ones, no, I just collect the dividend and I manually reinvest it elsewhere, just depending on what I'm buying at the time. Let's see. Ron says, have you thought about collaborating with the people behind Fast Graphs? No, I haven't really thought about that. What would that look like? That type of collaboration? Coyote says, I wish Fidelity made it easier to see free cash flow and long/short-term debt metrics. Yeah. I mean, you'll get that. You can see that in something like, obviously, like Seeking Alpha. You'll be able to see this. Well, free cash flow is easy here too. The total there, or the net debt and total debt here is pretty easy too. But once we roll out the full financial statements, you'll be able to see all of that. So, but anyway, guys, this is probably a good place to. Oh shoot, my wife left. Oh, okay. Kyle, last one. Maybe specific analysis tools and comparison tools for specific sectors. Okay. That's tough though. Like, what would you compare? What would you compare across sectors? That one would be really tough. I don't know what you would compare across sectors. But guys, we're gonna. Maybe that's what it is. Maybe that's kind of what Kyle was saying here, which you're saying. Segmentations for similar industries and industry data. Average industry. That could be good. You know how that could be good? So going back over here, let's say we're going to look up Snap-on. Average industry data. So like, for example, for the valuation, and actually Simply Safe Dividends has this, where there could be like an average chart across, or an average line across the chart here that shows where the average is for that industry. Like the average gross profit margin for companies in this industry could be, you know, somewhere down here or whatever. It can show where that is, which would be a good visual to show where this company is in relation to the industry average. And we've talked about that too. We talked about doing that too. Yeah, I'm going to write that down actually. That's a good idea. So, um, okay. Industry data for industry average metrics to compare to the company you're looking at. Okay. Yeah, that's a good idea, guys. That's a good idea. But anyway, guys, I think we're going to wrap it up here. I know I've got a few other questions just talking about some other stuff that may be pretty in depth, portfolio allocations, stocks to buy for a beginner. We're going to be here for another hour if we start getting into that stuff. So I think this is going to be a good place to wrap it up. But with that, I want to thank you guys so much for tuning into this dividend happy hour. I know this is once again, it's a little bit of a different time. If you guys are still in the mood to, check out some dividend stocks and keep watching, head over to the channel and unsubscribe. Wow. Okay. So if you guys are still in the mood to check out some dividend stock stuff, I just put out a video last night on Clear Secure, and you should check it out if you haven't done so already. But with that, I want to once again thank you guys for tuning in and hanging out with me this last hour. And I hope you all have a fantastic Saturday and a great weekend. What stock should I buy for a beginner? All in NVIDIA. I don't know. I would not. Okay. This is the last one. Then we're going. No, I'll in NVIDIA. I wouldn't do it. Stocks that you should buy for a beginner. So I can't give you any specific stocks, but just as a general rule of thumb, if you're looking to buy individual companies, I would recommend just thinking about the ones that you know and understand. Like which companies do you spend your money at? Where do you do your grocery shopping? Where do you do your banking? Where do you like to spend money at? Think of businesses like that you can maybe wrap your head around and understand. And I think that would give you a good direction for how to kind of start narrowing down which ones would be good to invest in for starting out. But I think the best place to start is within your immediate wheelhouse, long story short. So, but anyway, guys, that's going to be it. And thank you guys again. Hope you all enjoyed the rest of your weekend, and I will see you in the next one.